let's just spend a little bit more time on this consumer view of services. Remember the definition of a service. It enables value co-creation because it supports outcomes that are important for the customer to achieve without those associated costs and risks of provision. So this acronym of VOCR, let's just spend a little bit of time just understanding each of those. I think for value, we've already covered this quite a bit. Value is the perceived benefits, usefulness and importance of something. As we've said before, if it doesn't create value, why would you use it? Why would you want to spend money on it? And remember those important characteristics of value. Value is determined by the recipient, the beneficiary, the customer, the consumer, the people who receive a service are those that make a judgment on whether it creates value or not. And the other characteristic which is important, that don't assume you understand what your customer values, because value can change over time and circumstance. So V is for value. Next, let's look at O for outcome. And you'll recall earlier when we were describing a service, I used the example of an insurance company that uses IT services, and they use those IT services because the outcomes they're looking for, the results that they're looking for, of course, is to sell new policies, to modify existing policies, to capture payments, to process claims and pay out on claims. So all the things that are important for an insurance company to be successful, the outcomes, the results that IT services enable are really important. So outcome is defined within ITIL as a result for a stakeholder enabled by one or more outputs. Okay, so outcome at the top level is about a result. But it also says enabled by one or more outputs. So ITIL defines output as a tangible or intangible deliverable of an activity. Okay, so if there's one area of ITIL 4 where in an exam context people get confused and lose marks, it's often around understanding the difference and distinguishing between what we mean by outcome and what we mean by output. So at the top level, outcome is a result. At the top level, output is a tangible or intangible deliverable. To give you an example, when you take your ITIL 4 foundation exam, the outcome you're looking for is a result, which hopefully is a pass. Okay, so the outcome from taking the exam that you wish to achieve, the result you're looking for is to pass. And an output from the exam process and the activity around taking the exam is, if you are successful, an output will be a certificate, to confirm that you have indeed passed your ITIL 4 certificate in IT service management. And also, you'll also get a breakdown at high level of where you sort of won and lost marks. So that's an output. Okay, so outcome, result, output, a tangible or intangible deliverable. So let's just build on that a little bit further, because I say this is an area people do get confused. So we've done value, V, O, outcome, cost. So the definition of cost is relatively straightforward and understandable. ITIL defines cost as the amount of money spent on a specific activity or resource. Okay, pretty straightforward. What we need to understand and remember is the difference between the cost of provision and the cost of consumption. So in the context of what's the consumer view of services, when it comes to cost, it's what are the costs of taking this service. Remember our sort of mobile phone and our sort of price plan example. So on a monthly basis, how much money does that particular price plan cost me? That's the cost to me of that service as a consumer. The delivery of that service by your mobile phone service provider will be significantly higher, of course, because they're invested in 5G, 3G, 4G networks, all the resilience, the network monitoring, looking at single points of failure, putting in resilience. So the costs of provision are different from the costs of consumption. So as a consumer, I'm interested in the costs of using this service. So V, O, C, R, risk. So there are risks with everything we do in life. There's a risk getting up in the morning. There's a risk crossing the road. Risk is defined in ITIL as a possible event that could cause harm or loss or make it more difficult to achieve objectives. Okay, so, there are risks to the consumer of a service. Yeah, if you think of the mobile phone example, there is a risk you could lose your phone. There's a risk you could damage your phone. There's a risk your phone could be stolen. Okay, so there are risks associated with provision and there are risks associated with consumption. I always use the example of if you don't want to fail your ITIL exam, so if you want to avoid the risk of failing your ITIL exam, then don't take it. Well, that's probably not the sensible thing to do. Okay, so we've looked at value, outcome, cost, risk. Okay, so in terms of the consumer view of services, then it's important, as we mentioned earlier, value is a combination of outcome. It achieves what we need to be achieved. It's around cost. Value has to be affordable, and it's around risk. Risks have to be at an accepted level of risk. And each business, each consumer will have their own view as to what's affordable and to what level of risk they're prepared to accept. And remember, value is, of course, in the eye of the receiver, the beneficiary, not the provider. So when we look at the consumer view of services and we look at the VOCR, there's quite a useful graphic which we show here to sort of show value and the fact value is predicated on outcomes, costs and risks. And in this graphic, we sort of use these sort of weighing scales to sort of show that actually when we take a service or we move to a new service, or maybe we move from a manual business process to maybe a fully digitized, end-to-end customer journey, then there are some considerations around outcomes, costs and risks. So firstly, whenever we change from one service to another, from one service provider to a different service provider, or when we move from, say, a manual process to one which is now delivered as a sort of a service, then we're interested in what impact does it have on our outcomes, and what costs and risks are perhaps removed. And of course, when we move to something different or something new, then of course we're interested in then how are those outcomes affected, what costs are introduced, what risks are introduced. So this concept of costs introduced, risks introduced, costs removed, risks removed, in the context of the consumer view of services and cost and risk, the consumer is always interested in costs and risks removed, costs and risks introduced whenever there's a change. Okay, the provider might be interested in costs and risks removed and costs and risks introduced for provision, but for the consumer is only interested in costs and risks removed, costs and risks introduced. So to sort of bring this alive a little bit, I'll give you an example. Okay, so from my time in financial services, so not so many years ago, if as a customer you wanted to apply for an account, or you wanted to apply for a credit card, you wanted to apply for a loan, then you would fill in an application form. The application form might be sent to you through the post, perhaps as a bit of a targeted marketing exercise. It might have been in a Sunday newspaper, or you may have popped into a branch of the particular bank and picked up an application form. Either way, you would fill it in and you would send it off to a particular address. So within all financial services organisations, there used to be a department called account opening. So all these application forms would effectively end up at the account opening department, and they would go through a number of business processes to basically process the application and ultimately give a decision as to whether they would or would not approve a loan or a credit card or a new account. Now, account opening, would have quite a number of people. Okay, so dependent on the size of the bank, it could be 50 people, could be 100 people, but you've got a cost for account opening based on the number of people, so salaries, overtime. If you have people, you need premises. So they may well have been maybe a floor of a city centre office block, or you might have premises in a business park, but they need to be paid for in terms of leasing and rental. If you have premises, they need to be maintained. The bins need to be emptied and the toilets need to be cleaned. So there's a sort of a servicing cost of premises. So there's a cost for account opening based on people and premises and servicing, etc. Of course, with account opening, there's risks. So the fact you need people to process these application forms, of course, there's a risk of absenteeism, sickness. There could be risks associated with staff not able to get into work when the weather is really, really bad. There could be an extreme risk of the part of the city centre being closed off because someone's seen a suspicious package, and the police and emergency services are looking to investigate and remove it. Yeah, there's a risk potentially of human error. So, when people read an application form, when they come to do the data entry into the IT system, they get a name wrong, or they get a post code or zip code wrong. They may get a financial amount wrong in terms of a loan request. So there could be human error, which might ultimately result in the application being rejected sort of further downstream in the process. There's also a potential fraud risk of people who work in account opening. They sort of know how the sort of process and the system works. So for a colleague or a friend, they might be able to sort of nudge an application through, which, for most customers, it would probably be rejected. So there's a sort of an example of costs and risks associated with the outcome of actually approving applications for new accounts, credit cards or loans. Now, of course, filling in bits of paper, sending them off in the post seems quite old-fashioned now. So, of course, we've now moved to a fully digitised sort of end-to-end service where the customer journey is such that the customer can get a response probably within minutes rather than maybe several days with the old approach. So moving to this new digital service, of course, there will be costs introduced. There'll be costs removed. So in this case, maybe we don't need a department of 100 people. So we don't need salaries and overtime costs. They've been removed. Yeah, we don't need the cost of premises because this is a fully automated digital customer journey that the customer completes themselves. So we don't need the premises costs or the servicing costs. So those costs have been removed. But we've now got costs introduced, which we now may be paying more for the IT service that underpins account opening. We've certainly removed the risks of people not being available for work, whether that's sickness, absenteeism, or inability to get into work through bad weather, etc. But we may now have introduced additional risks associated with cybersecurity, because obviously this is now a digital service. We're recording a lot of information about prospective customers, and of course there's always a danger that that data could be compromised. So didn't necessarily have maybe that risk before, but we do now. Ultimately, costs removed, risks removed, costs introduced, risks introduced. What's the impact on outcomes? Okay, so the affected outcomes are, in this case, we can give a customer an acknowledgement and a confirmation of a successful application within minutes rather than maybe 7 days. Maybe the affected outcomes are now that we've reduced the chances of fraud or human error. Yeah, because we've now got a digitized service and we can validate fields, etc., etc. Okay. The reason the scales are not balanced is that value needs to be affordable and to a level of risks that we're prepared to accept. In some cases, yeah, if the outcomes are such that it creates greater value, then in some cases we might be prepared to pay more and we might be prepared to accept more risk, yeah, providing the greater value is there. So that's why the graphic isn't completely balanced. Okay, that's just to show that sometimes when we move to something different, we might be prepared to spend more, accept more risk if the value, the outcomes, the results we get are greater than what we had before. But the key message around this slide and around this graphic is the consumer view of service. Whenever we move or change, we're interested in costs and risks removed, costs and risks introduced for the consumption of the service. In the same way, if you change your mobile phone provider, yeah, you're interested in, does it save money because I'm moving to a different price plan? Have some risk been removed? Maybe the existing service provider, the service quality wasn't particularly good. You've moved to a different provider. Has it introduced more cost? Maybe actually I've gone for a different price plan. Yeah, and prepared to pay more money for a different price plan because it better fits what I need. Yeah, maybe I've got some different risks introduced, but on balance, yeah, the outcomes I want, the value I get, I'm only interested in costs and risks removed, costs and risks introduced. And that's the consumer view of service: value, outcome, cost, risk. And remember, outcome, result, output, deliverable. So let's just build on that a little bit further, because I say this is an area people do get confused. So let's think of a scenario where a user can't work and the user contacts the desk and the desk take the call and the agent starts to go through the activities associated with incident management. So the user can't work. They contact the desk starts to record information. We open a ticket, give a reference number, start to log information, start the diagnosis, and let's just assume that this particular call to the desk, this incident is resolved by the agent at the first line, and quickly the user can now work. In the context of outcome and output, the user, when they rang the desk, the result they were looking for was to be able to get back to work as quickly as possible. Okay, so in this example, that outcome, that result was achieved by the desk, the incident resolved at first line reasonably quickly. So the outcome for the user, I couldn't work, I now can work. Yeah, outcome, result. Now, the agent followed the incident management process and performed a number of activities as part of incident management. And as part of that incident management process, there are a number of deliverables, tangible and intangible. So a tangible deliverable, if you follow the incident management process for every incident, well, a tangible deliverable is every incident has a reference number, an incident ticket. There's an incident log where you've recorded information, who called the desk, what time did they call, and all the sort of activity that's taken place to ultimately close and resolve that incident. Some service desk and the service desk tools, as soon as you resolve an incident, it sends an email straight away to the user just to confirm that the incident has been resolved. If they're not happy, click on this link and we'll reopen it. If you are happy, can you just give us some instant feedback on how you felt the desk handled that incident today? So you might have a red, amber and green sort of button just to give some instant feedback. So that's tangible. That's a tangible deliverable. We've got an incident ticket, we've got an incident log, we've got some feedback from the user. What might be an intangible deliverable? Well, that could be the agent's knowledge has been enhanced. So as an agent, I've never dealt with this particular situation before. Having been through this, having successfully resolved the incident, guess what? If I have a similar call later today or tomorrow, then my knowledge has been enhanced and I'll be able to deal with that incident in probably a much quicker and more efficient way. So what's an intangible deliverable? Well, that could be that the agent's knowledge has been enhanced. So as an agent on the desk, I've dealt with this particular call. I've never seen this before. I've now successfully resolved it. If I get this call or a similar call later today or tomorrow, then I know more about it and I'm going to be more efficient and effective in dealing with that particular incident should, a similar situation reoccur. So I wouldn't get too worked up on what's a tangible deliverable, what's an intangible deliverable. I've never seen a question yet which asks you to select what is a tangible or an intangible deliverable. But what you will be expected to understand is what is the difference between outcome and output. So remember, outcome is a result. Output is some form of deliverable from an activity. Now that example of a call to the desk, it's giving you good insight in terms of what was an outcome from that particular call to the desk and what was the tangible and intangible deliverables achieved by the desk following the incident management process. And finally, just a reminder, when we're talking about the consumer view of services and the value of services, just a reminder on utility and warranty. Utility provides the functionality. Warranty is assurance that the product or service will be there when we need it. So utility, what the service does. Warranty, how the service performs. And to create value from a service, then the service has to be fit for purpose. So utility sometimes is also referred to as being fit for purpose. It's fit for the purpose intended. If it's a service in a contact center for insurance, it's fit for purpose because we can open new policies, we can modify existing policies, we can close policies, we can capture payments, we can process claims, etc. What the service does. And it has to be fit for use, which is sometimes a term also used for warranty and this assurance. So it has to be fit for use. It has to be there when we need it. It has to be at a level of performance that supports a busy contact center. It has to be fit for use in that if it fails, we can recover quickly. And of course, it has to be fit for use in terms of security. Okay, so utility, functionality, what the service does, sometimes referred to as being fit for purpose. But you also need warranty. This is the assurance that the service will perform when required. Fit for use. And again, just as a reminder, to create value from a service, it must have functionality. It must have assurance on its ability to perform. So it must have utility. It must have warranty. You can't create value from a service if you've only got one. You need both.